Hello, everyone. Welcome to Chapter 6 of the textbook. This is Module 6. In this chapter, we're going to focus on discussing income or loss from a business. So far from chapters 3 and 4, we've only really talked about personal individual employment income and the credits associated with it. In this chapter, we're going to focus on business income. And in the next chapter, Chapter 7, we will talk about property income. So getting started. So income or loss from a business. The thing about the Tax Act is how they define income is they use what's called the source concept. The Income Tax Act identifies three major sources of income. There's employment, which we've already discussed. This chapter will discuss business, and next chapter will discuss passive or property income. So in both chapter 6 and 7, we will visit this idea of source of income. So what is a source of income? A source of income has certain features. The first is continuity. It's activity that occurs over a period of time or activity that occurs continuously. When you get employment, when you get a job, you will go to that job every day or most days, or you'll have a certain number of hours a week. You are continuously working that job. So that continuity establishes that this is something that is a continuous driver of income. It's a source. There needs to be a profit motive, which means taking part in this activity is done so primarily to make money. There's a difference between me going to work every day for a paycheck and me going to partake in my hobby. I might go somewhere to knit every day, but I'm knitting for my personal enjoyment. If I'm not selling those products, if I'm not doing the action in order to generate revenue, then there's no profit motive. And then if something is defined to be a profit motive, we can report that income on a net basis. Net basis means we measure income by showing our gross income, all of the amounts we've received. And then from that income, we are allowed certain deductions and expenses related to earning the income. So just because I have income doesn't mean I can expense anything, but expenses related to generate that income source. I mentioned knitting. If I knit a whole bunch of sweaters and I sell those sweaters, the yarn cost money. So I can expense the yarn for the sweaters I made to sell. The expense has to be related to the income. Now, the yarn I purchased for my own sweaters or sweaters I give away to family members at Christmas, that's not a deduction I can apply against my income because that act, that yarn, and those activities were not in the pursuit of profit. So if an activity has a profit motive, I can report the income on a net basis, which means I add all my gross, and then from it, I can subtract certain expenses. If something's deemed not to be a source, then there's no expenditures that we can claim on it, but we also don't have to recognize the receipts, which means we don't have to report both the income and the expenses because it's not a source. Exercise 6-1 says in the previous paragraph, there's an example of selling excess vegetables. So I'm just going to scroll up and we'll go through that example. You live outside the city and own a small piece of land. You decide to grow vegetables for your family's consumption. In 2025, the growing season is longer than expected, and as a result, you have extra vegetables. You set up a roadside stand and sell the excess, receiving $1,200. You estimate that your total expenses, including a portion of your home expenses, amounts to $5,000. Can you deduct the net loss of $3,800? That's our total income, our gross income of $1,200 minus our $5,000 of expenses. At a minimum, are you required to include the $1,200 of receipts as income when you file your tax return? So the key thing here is for the categories of source of income, is there continuity? In this situation, there probably is. Growing vegetables is a time-consuming activity. It's done over the course of a season. So we probably had to work at that small garden, that plot of land, frequently over a period of time. So there was continuity. If it's a profit motive, then we can declare on a net basis, meaning that loss of 3,800. But the question is, Is there a profit motive? We don't grow the vegetables to sell, we grow it to eat ourselves. It's our family's consumption. The fact that we sold some of the vegetables for $1,200 was incidental. It's only because this particular season was longer than usual. So we got $1,200. Since it's not a source of income, we don't have to report that 1,200, but that means we also don't get to claim the expenses of $5,000. If it was deemed a source of income, then we would come out ahead. We can deduct the net loss of 3,800 and that would save us tax dollars. And this is why the major test for the CRA is, are you trying to make money? If there's no profit motive, then this loss is never going to be positive, which means we would only be deducting from our taxes without ever having any intention of adding to our income, of adding to our taxes. So, since there's no intention to make money, we cannot claim the expenses. And this comes into anything related to our personal benefit. If I buy a video game and play it myself, I don't get to expense the video game because it's for my personal enjoyment. I didn't play that video game to make money, so I cannot deduct from my taxes any expenditure that I want simply so I can use it myself. But if I'm buying that video game to resell to other people, well, now that action of buying the video game is related to an income profit motive. So now the costs can be deducted from the money I receive. If they allowed me to deduct anything, I would never show positive income, right? I would continuously add those expenses that I end up using for my own enjoyment. They never produce income to be taxed. So the question for exercise goes a little further and says, if we determine the activity is not a source of income because there's no profit motive, what do you think the individual could do to create a source of income? So we currently have a loss, but just because we have a loss doesn't mean we're not trying to make money. Businesses experience losses all the time, especially in their early days when they're trying to grow. There's a lot of initial investment that goes in. You're trying to solidify a production process. You don't have a customer base large enough to garner a profitable um, sales force. So businesses have losses. Just because a business shows a loss doesn't mean that there's not a profit motive. Right now, we see no profit motive, but what can we do to convince the CRA that a profit motive exists? There's a couple things we could do. One is if we act as a business would act, that can say there's a profit motive. So right now we're consuming most of the vegetables, but if we changed it that we sold the entire harvest or most of it and only ate the vegetables that were going to go bad, that weren't moving off the shelf, well, that might show that our intention of growing the vegetables was for sale, not for eating. Right now, the income's below cost, so we need to look at the potential revenues. If it costs $5,000 to grow these vegetables, can we sell it for more than 5,000? If it's not mathematically feasible for us to generate 5,000 or more of revenues, then there can't be a profit motive. There's no reasonable expectation that we'll ever have a positive outcome. But if we sold the vegetables and it could come out to $7,000, well, now there is a profit motive. They'll also look at our activity to say, are we running it like a business? Do we have expectations to expand this small piece of land? Instead of a roadside stand, are we reaching out to retailers to supply grocery stores? Or are we advertising to try and build customer base? Are we purchasing equipment to expand our operations? Are we hiring staff to take on a greater workload? If we're showing intentions of investment, of effort, of time, then we can demonstrate that, yes, we're not making money, but we intend to. We hope to make money soon. That can establish a profit motive, and now that $1,200 of revenue will be included in income and will be allowed to expense the related $5,000. So that would allow us to deduct from taxes this year. So why is this important? The important is to determine it, the important of establishing a business is because it allows us to expense our expenditures. It allows us to deduct it against our income that's being earned. Um, the expenses prior to a commencement and ceasing of business are not deductible. So right now, our garden is not a source of income. Once we decide to turn it into a business, only the expenses after that date can be deducted. Um, so we'll go right into this. Defining a business. This includes a profession, calling, trade, manufacture, or undertaking of any kind whatsoever. So the Tax Act is extremely broad. Almost any action can be considered a business. The defining factors is, does it take time, attention, and labor devoted to the activity? Is there a pursuit of profit and incurring of liabilities to other persons? It's not as relevant, but it is a part of it. Basically, when people give us money, do we owe them something in return? I was selling video games. When I get money, I owe that person a video game. If I was a contractor that built, backyard decks, someone gives me money, I owe them a deck in return. Perhaps I take a loan from the bank in order to facilitate the investment of my business. I owe them money. Am I incurring liabilities to pursue the profit? It's not as important because really it's an assistance criteria to establish pursuit of profit. But really they're looking at time, attention, and labor, and are we doing it for money? The fun thing about a business is labor is one of the key factors to determine, yes, this is a business. The thing is, you personally do not have to do the labor yourself. As long as you hire staff and someone is performing that labor portion, then that is a business or that can count towards that labor requirement. So we have the definition between business and property. So what is business versus income from property? There's two separate sources of income, but under the same rules. They'll still be included in income and deduct expenses on a net basis. The differences in tax treatment between them, there are differences in the fact property income doesn't get all the same treatments that business does. For example, for RSP contributions, business income is considered part of earned income, but property income is generally not, um, except rental property, but generally property income's not. Business income is ongoing, continuous activity. That's the thing that requires that time, intention in labor. Property income follows the same source of income, except there's not really a labor requirement. Property income comes from I own something, and my income comes from just owning that piece of paper or that piece of property. If I have a rental house, those people are paying me money simply because I own the property. They pay me so they can use it. If I have shares in a corporation, I get paid money every time the corporation declares a dividend, not because of the work I've put in, but because I own the share. My income is by right of my purchase, my property, my ownership. Business involves ongoing activity. So one action can be similar to business or property, and they're defined by the amount of activity that goes into it. Um, so let's just go to exercise 2. So 6-2, source of income. You live in Toronto and have recently purchased a farm 100 kilometers away. You plan to retire to that location one day. In the meantime, you hire 3 individuals to operate the farm, which has been profitable for many years. You also rent the farmhouse to unrelated individuals at the going market rental rate for a period of 2 years. While there are a number of buildings on the property, including barns and large tool sheds, no part of the farmhouse is used in the farming business. In the second year, you spend $11,600 on a utility service connection of natural gas to the farmhouse. Are we carrying on a business? How many sources of income do we have? Is the utility service connection deductible? So first we want to establish a profit motive, and it's easy to find here because the farm's already been profitable. We have farm that is making money. So if we purchase it because we want to retire to it one day, but in the meantime, we are operating the farm for profit. So there's a profit motive. But is it a business? So we have to look at what is the involvement in it. Um, there's a number of buildings, barns, no part of the farmhouse. Oh, yeah. So we hire three individuals to operate the farm. So although we're not working that farm ourselves, we've hired staff to fulfill that time, effort, and labor portion. So that confers that the farm is a business. The farm's not growing on its own, someone is working that land. The house, however, is not, we're not actively working on the house. That property's just on the land. We're renting it. So even though that house and the farm are all part of the same purchase, we have two sources of income. One is a business, the farm, and the other is property, the rental income from the house. So the question here is, in the second year, we spent $11,600 on utility service connection to the farmhouse. So we've made a modification to the farmhouse to bring natural gas. Because it's a source of income, a property income, we can deduct that connection. We might, because of its amount and what it's doing, we might include it as part of the cost of an asset in the house and amortize it through CCA. But or if it's simply a repair to a natural gas connection, then we might deduct it as maintenance. But the important fact is we can only do this so long as the farmhouse is still considered a source of income. So if we look at the solution, is the farm a business? We have to look at devoted time and effort. It's performed by staff or contractors. Yes. Pursuit of profit. It earned profit for many years, so it's reasonable to expect it will continue to do so. So we can consider the farm a business. But the farm land can be broken up into two properties, the farm itself and the house that sits on it. The house is separate. It's property income because it's passive in nature. We get rent for however long those people are living in the house. We don't necessarily need to do anything to the house, but we did do something. We have a utility connection. If it's for property, this says non-deductible because the case used to say landscaping, which landscaping was non-deductible, but I do believe the utility connection would be deductible because it's a modification to the house. So I guess I'd leave it non-deductible because we wouldn't necessarily expense it due to the type of asset it is or the type of purchase. I would say it's a modification to the house, so we would add it to its original cost base, in which case it would only be deducted if we choose to take CCA. It's not deducted as an expense, but we could potentially deduct it through CCA. So I will leave that as is for non-deductible. That's long enough for video one. I'm going to leave it here. When we come back, we'll talk more about commencing a business. Thank you for your time. See you in the next video.